Right, guys, we have a few questions from Gurmant and Aiman, both asking about the various volatility indexes that we use and how we use them. So thanks for the questions, guys. There's actually quite a few volatility indexes. Some of the ones that I use on a daily basis is, of course, the VIX. That one you should know is tracking equity volatility. There's also OVX, which basically tracks oil's volatility. GVZ, the other one you've seen us use, is tracking gold price volatility. Apart from that, you also have the MOVE, which tracks the volatility of treasuries. You get the VXN, which tracks the volatility of the Nasdaq. You also get separate volatility indexes for things like the Russell 2000, for the Dow Jones, etc. So you really get a vast amount of different volatility indexes. For things like FX, you can use something like EVZ, which is the volatility index tracking the euro. The way that we prefer to use volatility when it comes to FX, though, is using things like implied volatilities as well as risk reversals, which you can find on the Icon platform. Now, if you have access, whether it's to Icon or TradingView, you will be able to track so many different volatility indexes. I'm actually in the process of building out an Icon monitor like the one we have for the intermarket analysis, but one specifically geared towards volatility, tracking that across major asset classes. The thing that's most important really about volatility, guys, about volatility indexes, is that they track the implied volatility for their relevant assets and not the realized volatility. So they are tracking the implied moves in these assets based on options pricing, which tells us a whole deal about the amount of uncertainty that the market is pricing in for that particular asset. Now, the most important thing about volatility is that it can either be rising or falling and trending or non-trending. So the best environment for any particular asset is when you have falling volatility that's also trending lower. And the worst possible environment for an asset is when you have rising volatility that's also trending higher. Thus, there's usually an inverse correlation between the asset and its volatility. So if volatility jolts to the upside, moves higher, that is normally indicative of rising uncertainty, which is, of course, bad for the asset's price, which we saw with equities, for example. That big jolt to the upside in volatility. So, of course, a big push to the downside in the equity index. And at the other end of the spectrum, whenever you have falling volatility, that means there's less and less uncertainty being priced in, which is, of course, good for the assets. You always have that inverse correlation. Now, what can sometimes catch market participants out in the short term is when you have more of a temporary jolt in volatility, where you have a violent, massive spike in something like the VIX, like we had over the last few days, which isn't necessarily a trending move. It's more of a short-term move. And these moves can create a lot of violent swings because obviously there's a lot of implied volatility being priced in. And what oftentimes happens is you have that big spike. And if it's not a trending move, you often get the very next day, you get lots of chasers trying to chase these equities moves lower, trying to chase risk assets lower. And what happens is they basically get left holding a big bag of what, because they try to chase these moves lower, instead of looking at them in the bigger picture. That is why we explained yesterday at the start of the session, before we have the big ramp to the upside, we said that we are very cautious in terms of the way that volatility has been moving, because it's in terms of the bigger picture, nothing has really changed. And in light of that bigger picture, we didn't have any real appetite to try and chase those moves lower in the short term. So I think, to show you a very practical way that I use that falling and trending or rising and trending, in a particular asset is looking at gold. I'm currently trading gold as we speak, and I'll show you what the premise was. So right now, that I'm holding a short to a medium term downside bias in gold, which we've explained in many videos over the past few days and weeks. And that is mostly driven on something like real yields and the market's expectations for curves at the back end of the US to start steepening. So that means a move higher in US 10-year, which should put upside pressure on something like real yields, which is, of course, one of the biggest drivers for gold prices. Now, in today's session, so I always start with my bias, right? So I already had that short to medium term downside bias in gold. And the reason for that, one of the key drivers is US 10-year. If I see US 10-year moving higher, that should put upside pressure on something like real yields, and that is something that should put pressure, downside pressure, on something like gold. So that's the bias, that's the premise for the trade. So in today's session, I saw gold was really supported in the short term, obviously supported by a weaker dollar. We've had a weaker dollar for the biggest part of the session. However, with this sharp move we had to the upside in something like US 10-year, I thought gold had been making solid gains despite US 10-year moving higher. For me, I thought that, okay, this was interesting. I have that downside bias. It's moving into a key area of resistance at the top end of that range that it's been stuck in recently. While US 10-year has been moving higher, I didn't see that move being sustained. So what I did then is I basically looked at, let me just quickly turn off that squawk, sorry. So earlier in the week, you guys will recall that I took a trade on a gold to the downside. And the one trigger that made me close out that trade, even though the dollar was moving higher, even though US 10-year was stable, was that when the market opened up, that was on the 26th. When was that? 26th was on Tuesday. So when the market opened up, we saw GVZ actually breaking to the downside. Can you see it was a trending move lower? It was falling and trending lower. When I saw that, I thought, you know what? That is normally indicative of a possible move to the upside in price. I decided just to liquidate that short position, even though I thought there was premise for gold to continue moving lower. Now, in today's session, we have very much the same similar type of setup. We've got US 10-year pushing to the upside. And even though the dollar is moving lower, it's still, it's still very much range bound in that recent range that we've been trading in. So the fact that US 10-year was moving higher, gold was moving into a key area of resistance, that already caught my attention. And then as GVZ opened up, as the US cash open got underway, we actually saw GVZ opening up well to the upside for the second day in a row. So again, you see we've broken right back above that recent area. We've taken out all of that lower trending volatility in one day, and now we've opened up higher again. So that for me was already a great trigger point to use for a potential entry in gold. And I basically got filled at let me just double check here. I got filled at 1861 as we broke below that key range area that I've been marking on the chart. So in this example, it was, the premise was there, the bias was there. We had a great level to trade from. I was basically just waiting for a trigger point. And for me, that was GVZ opening up much higher in the session. So of course, if we see GVZ gold volatility starting to break down in this session, obviously that's something that you can use also as a potential profit-taking mechanism, saying that, okay, volatility is calming down. Let me take some profit off the table here. But if we do start to really see price accelerate to the downside, then we should actually see volatility breaking even higher in the session, which is something that I am, obviously in the trade for. We'll see whether that happens or not. But that's a very practical example of how I use that, either falling and trending or rising and trending volatility as a trigger point in my trading. So any other questions, guys, as usual, please don't hesitate to let me know.